So let's talk about Take-Two Interactive. Now, this stock was under some serious pressure, down over 18% in just the last month. But then on February 3rd, their latest earnings report dropped, and it completely flipped the script. We're going to break down exactly what happened. And boom, the market's reaction was immediate. The stock just surged, jumping over 5% in after-hours trading. That's a really powerful signal that Wall Street was listening, and they absolutely liked what they heard. So you gotta ask, what was really behind this rally? Well, the market had these two huge fears hanging over the stock. And frankly, management just met them head on. Let's break down how they did it. All right, so where does the story begin? It all starts with a massive beat on the headline numbers. And this wasn't just a little bit better than expected, it was a total statement quarter that put a lot of the market's recent fears to rest. I mean, just look at the scale of this earnings surprise. The company delivered an adjusted EPS of $1.23. The consensus on the street, 83 cents. That is a 40-cent beat, which, believe me, is a huge surprise to the upside. And it wasn't just on the bottom line. The top-line strength was just as impressive. Net bookings, which is a really key metric for them, came in at $1.76 billion. That's up a staggering 28% year over year, and it just obliterated the street's estimates of around $1.59 billion. Okay, so where did all this outperformance actually come from? Let's pop the hood and take a look. This wasn't a one-hit wonder. The strength was really broad-based, right across their entire portfolio. You know, the real engine driving these results is what they call recurrent consumer spending, or RCS. We're talking about things like in-game purchases and subscriptions. That was up 23% and now makes up a massive 76% of the entire business. That points to some incredible stability and really deep player engagement. And this growth was, it was everywhere. GTA Online saw its recurrent spending jump 27%, mostly thanks to a super popular new update. NBA 2K up an impressive 30%. And even the mobile portfolio, led by Zynga, posted really strong 19% growth and bookings. And you know, the message from the CEO, Strauss-Zelnick, on the call, it was crystal clear. This wasn't some accident or just one single game carrying the whole company. Nope, this was a comprehensive, company-wide success story. Look, a great quarter is one thing. That's fantastic. But what really got the stock moving was that this strong performance was paired with an even stronger message about what's coming next. And management didn't just talk the talk, they backed up that confidence with some serious numbers. They raised the full-year outlook for net bookings, sure, but the real eye-opener was the operating cash flow. They nearly doubled the forecast, taking it from $250 million up to $450 million. That's a huge signal of just how healthy the operation is. And then they delivered the date that every single investor was waiting for. Management stood firm and reconfirmed the November 19th launch for Grand Theft Auto 6. They even said it, plain as day, that this will set a whole new financial baseline for the entire company starting in fiscal 2027. But there was another big piece to this call. It was all about addressing this major fear that was just weighing on the stock heading into the report. And that's the whole narrative around generative AI and whether it could disrupt the gaming industry. So what they did was they went right at this narrative, this idea that new AI tools for world generation could somehow devalue their creative moat. They pushed back, and they pushed back hard, basically defending the one-of-a-kind craftsmanship and the sheer production depth of a studio like Rockstar. Right, so their whole argument on the call was that these AI tools, they're just one tiny piece of the puzzle. They said they're not in the same ballpark as a full proprietary game engine. An engine handles everything, the physics, the story, the missions, and most importantly, that emotional connection with the player, stuff that AI just can't replicate. All right, so let's put it all together. What does this actually mean for the stock from here on out? This is our take, the next call. We're going to break this down into 3 simple parts for you. First, we'll look at the immediate Q4 guidance. Second, our core thesis for the stock. And finally, we'll give you our official rating. Okay, so first up, looking at the immediate future, Q4, management has set the next hurdle. They're guiding for net bookings between $1.51 and $1.56 billion. This is going to be the key data point the market watches to see if this incredible momentum continues as we get closer and closer to that GTA 6 launch. So here's our core thesis. Here's what we really think is going on. This earnings call was plain and simple, a successful de-risking event. Management calmed the market's 2 biggest fears, near-term execution and the AI threat.
And by doing that, they put the focus squarely back where it belongs, on the massive, company-defining catalyst that is the Grand Theft Auto V6 launch cycle. So when you put it all together, the stellar execution, the raised guidance, and this super clear and confident path toward the largest catalyst in the company's history, well, for us, our rating is outperform.
And that really leaves us with the one big final question, right? The narrative debate, it seems to be settled, at least for now. From here until November 19th, the focus is all on one thing: execution. The path is clear, but the challenge of actually delivering the biggest entertainment launch of all time, that is immense. This is not financial advice.